Good morning, everybody. All right, it is 10 o'clock Eastern, 9 o'clock Central, and I know that we have some folks on from both the Eastern time zone and the Central time zone. So we'll just give everybody another minute or two here, and then we'll go ahead and get started in case anybody was having some difficulty logging in. But thank you for joining us this morning. We look forward to talking with you. All right, it is officially 10:01 Eastern, 9:01 Central. So we will get started to keep on a good timely manner for all of you. But welcome. I'm very excited to be here today. My name is Chris Gluck, and I am with AMBA or AMBA. Hopefully, all of you have heard of us. We are the group that partners with your association to bring you a multitude of suite of products from discounts that you can get through Passport, benefit products as well, supplemental products, and specifically the fixed indexed annuity, the tax deferred asset protection plan that we're going to be talking about today. We have folks on here, like I said, from a couple different states. So from Alabama and from Georgia. And depending on what state, you're joining us from, your particular association in your state is an exclusive partner with AMBA. So for example, if you're in Georgia, you're most likely affiliated with the Georgia Retired Educators Association, or in Alabama, you might be affiliated with ARSEA or AERA. All those names are too long. I always tongue tie them, so you're getting an acronym from me instead. But we're excited to be here with you. I'm just going to kick this off, tell you a little bit about me, hand it over to Kristen, who is our field market leader and local leader for your area, and then turn it over to Dallas Mullins, who leads our National Retirement Solutions team. So again, my name is Chris Gluck with AMBA. I cover this. I'm the senior vice president for half the country. We call it the East Market. I currently live in Tampa, Florida, but have originally grew up right on the Illinois-Wisconsin border, which is where you may hear a little bit of my accent from. With a number of different associations, in all those different states. And I'm very excited to be here today to work with you and to talk to you about these different products. A little bit about AMBA. We've been around since 1984, and we have been a partner with many different associations, first starting in Texas with the Texas Retired Teachers Association, up through over 100 different association partners today. Primarily, all the associations that we partner with have to do with either education, police, fire, public employees, active educators, principal groups, etc. So along those lines. And over those years, we've grown from one association endorsement to over 100. So it's been great. And as we go through today, if you do have any questions whatsoever, if you take your smartphone out and you grab, or a smart device, whatever you may have in front of you, and if you pull up your camera and you just hold it over the QR code on this first screen, you will be able to pull up a form on your device that basically is just your name, telephone number, email, and that way you can click on there and say, hey, I would like to get more information on X, or I would like to set up an appointment to talk about X. And then Kristen and her team will be able to follow up with you. This QR code is on the screen right now, and it will also be on the screen at the very end as well. So with that said, I want to hand it over to Kristen. And Dallas, you can click to the next slide, and then I'll hand it over to Kristen to talk about her and who she is and where she lives.
Good morning, everyone, and thanks for joining us. This is really exciting information that you're going to receive today. I do live in Brazelton, Georgia. I've been with AMBA since 2017. I have a team of 16 that's spread out over Georgia, Florida, and Alabama to help retirees and also pre-retirees to understand their benefits and what the association offers them. Help drive membership so that we can grow the association and just keep you educated on what's coming down the pipeline. And we're always here to help you in any way. So you can always reach out to the association to get my number, or I will make sure to drop it in the chat so that you have it. And just feel free to reach out at any given time. We're always eager to help and make sure that you understand what's going on. And I'm very glad to be here.
Absolutely. And at the bottom of your screen, there is a Q&A box. And so you can put your questions, if you have any, in that Q&A box. And Kristen and I and Dallas will be able to see those questions, and we can respond to those at some point throughout the presentation. And then the last slide on here, or that we're going to go through before Dallas takes over, is the next slide. And that is how your association, impacts the forces that are really affecting you. And this is what Kristen was talking about. The number one item on here is they are a pension watchdog. And so as you kind of click through the next click, it'll bring up pension watchdog. And then number 2 is preserve any health benefits and pay raises. Number 3 is it connects members to the local community. And then number 4 is it offers exclusive benefits and discounts. And so your association is extremely important to helping all of you thrive in retirement in many, many different ways. And these are just kind of 4 main categories that all of that falls under. And as Kristen talked about bringing in members for your associations, that's one of our main responsibilities here at AMBA, is to do that, because the more members that you have, the stronger your association is, and the more representation you have, when it comes time to have a large number of representatives to help fight anything that might be attacking your pension or health benefits. So with that said, that's a quick intro of myself, Kristen, AMBA, and what we do. And then the star of the show, I will say, is Mr. Dallas Mullins. I'm going to hand it over to him, and he will go through what we're going to talk about today primarily, which is the asset-deferred asset protection plan, or tax-deferred asset protection plan. So Dallas, I'll hand it over to you.
Great. Hey, Chris. Hey, Kristen. Good morning, everyone. Thank you for attending this morning. And hopefully when we're wrapped up here in a few minutes, you'll have a lot better insight as to some other options that are out there for you and your nest egg, and what that looks like. So the goals of today, let me get this going. Sorry, everyone. The goals of today's educational series is to figure out kind of what makes up your nest egg. That term is very easily kind of overused. What is a nest egg, and also kind of dissecting that nest egg, and how can you make it better? How can you make it safer? How can you protect it from market loss? How can you really ensure that nest egg transfers to your kiddos? How can you ensure that nest egg has the best tax advantages possible out there in the market? So we're going to isolate the 5 biggest threats to your nest egg today, how you can protect the nest egg against those threats, and how to have peace of mind for this, this next phase, so to speak, of your retirement, and really to make the most of your options. And in digressing just a little bit, everyone, my name is Dallas Mullins. I've been here with AMBA since 2008. I'm celebrating my 16th year just a month or so ago with the company. I've had the opportunity to service our retired educators, our retired state office employees in all of our different groups around the United States for that time period. And it is an absolute honor to come to you all this morning and really help you have some different options, that a lot of you might not know was out there. So kind of that nest egg, that stable retirement. So 3 main components of a stable retirement income. Number 1 is your pension. Most retirees, most clients in our groups that we're exclusively endorsed by, they have the beautiful opportunity to have a pension. And pension is a very dying thing around the United States for other industry, other job sectors, if you will, that aren't state offices, that aren't school related. And so for you to have that pension is a very, very, very powerful thing. But I think we all know there's a lot of forces against that pension. There are a lot of inflationary forces that we're going to talk about, as well as kind of just overall market forces against that pension. So it's important to understand, where as great as that pension is, that number three, and I'm jumping ahead just a little bit in the other savings, that number three is a very viable source to help bolster that pension, to help give you that peace of mind if inflation continues the way it is now. Will I be able to continue to afford the lifestyle I have today in 5 years, in 10 years, and those sorts of things? So you've got your pension. Depending on your state, Social Security might or might not be a viable option for you. I live down in Texas, so unfortunately our retired school employees down here do not receive Social Security benefits, nor do they receive their spouses through what's called the government pension offset or the windfall elimination provision. So depending on your states, it really just kind of depends if Social Security is something that comes along for your life along with your pension, or a fraction of it comes along with your life. Again, putting more towards that number three and kind of getting around that circle there on other savings. What that other savings did for you. Were you diligent enough throughout your years of working to pay into some of the extra retirement accounts, such as 403s and those sorts of things we'll visit about here in just a second? Do you have a little bit extra at the bank? And what can you do with those funds to really help, number one, and counteract if you are able to get number two or not? So just a good kind of mindset of what makes up a stable retirement income and stable overall retirement, and stress-free. So nest egg, we talked about nest egg a little bit. And for today's flow, if you will, we're going to kind of really dissect the nest egg into what it isn't and what it is. So what are we not talking about a nest egg? What might not be able to be utilized in a tax deferred asset protection plan, also known, as Chris said, as a fixed indexed annuity? We don't use active pensions. An active pension is not the source, so to speak, for any sort of funding for this account. This account we're going to go over here in a little bit is not for new contributions. This program we're going to go over in a few more slides. This is for a bucket of money you've already amassed that you want to be safer, you want to be less volatile, you want to have no fees and no expenses and those sorts of things. Your spouse's Social Security, where that might make up absolutely number 1, 2, 3 of a stable retirement income, that is not a funding source for the tax deferred asset protection program. Mattress money, always love that one. So my grandfather, God rest his soul, he could not sleep at night unless he had, I never understood the number, $15,000 in crisp $100 bills under the mattress, if you will. And that was his peace of mind. That was his grab money. That was his money that if he was, if he needed to do something, if something, kind of went awry, he had it right there. Another kind of fun part of a way to think about mattress money is your emergency fund at the bank. Everyone needs to have, good liquidity, easy money that you can get quick and utilize in regards of what that is. Now, what we find a lot is there's too much money at the bank. There, a lot of retirees think, there's no other safe option for kind of money, so to speak, than the bank. And we're here today to show you a little bit different of a flow there. So in regards to what's not being utilized, we don't want to utilize your mattress money, your emergency fund money for our program, for the program we offer nationwide to all of our groups spanning across the United States, is what I'm going over with you today. You need to have that liquidity. We're here for that long-term money that you've kind of forgotten about, or that is out there that you're not going to need to spend in its entirety, very soon, so to speak. Structured settlements. I know that I always laugh. My wife and kids and I always enjoy the J.G. Wentworth. I don't know if you guys have that in your local area, but the structured settlement, need cash now kind of thing. And so, structured settlement is kind of, a very pensionary based thing where you've got a dedicated income coming out of that, a dedicated payment every month. That's not what's being utilized, in that as well. So these are just some alternate sources of maybe income or funds that are out there. And let's transition over to the yes column, if you will. What is a good opportunity for our tax deferred asset protection program that, again, we're going to continue to go in with you a little bit deeper and deeper throughout the slides. One of your best funding sources, everyone, are your 4Os, your 403s, your 457s, your 401s. And what are those? Those are pre-tax sources of funds, if you will. I mentioned that term bucket of money earlier. So that is money that went in before it was taxed through your paycheck or through your spouse's paycheck. That is money that is, qualified funds is what it's technically called through Uncle Sam IRS terms. And those are funds that your required minimum distributions are required out of, if you will, at age 73 or above, or 70 and a half, depending on kind of when you hit that mark. If you're not receiving required minimum distributions today, if Uncle Sam hasn't forced you to distribute, so to speak, out of your retirement accounts, that age is 73. So those are absolutely perfect funding sources for our fixed indexed annuity or tax deferred asset protection plan. Those are synonymous, just kind of ways to think about our investment option for you all. 403B and 401k plans are funds that are very long term. They've taken years to grow. If you spend money out of there, every bit that comes out is taxable, so to speak. It is earned income, every bit that comes out of there. So what does that mean? That means it's not mattress money, everyone. It's not money that you're gonna, spend for your normal daily purposes. It's certainly available money to spend for you guys and gals out there. It's certainly money that you've earned, that's grown and such of the sort, but it's not right now money. So that's kind of one of the best funding sources, for our accounts. IRAs and cash balance pensions, kind of in that same, bullet point there of the 403s, the 401s. We're talking pre-tax sources. And really, I ask you this morning, and I ask you today, as we're going through these next few slides, to really kind of shape your thinking on monies that you may have out there. Is it short term or is it long term? Is it money I'm going to need if the water heater goes out? Is it money I'm going to need, to help my grandson, later in college this year? Is it money I'm going to need to spend in its entirety very soon? And if that answer is yes, I am going to need to spend it in its entirety soon, or yes, I might, and that sort of thing. That's what we'll call short-term money, if you will. If it is money that you have not spent, money you don't intend to spend, short of a major, kind of health ailment, or short of a major, life event, if you will, retirement-based money, that's what we'll refer to as long-term money for our talk this morning. So this yes column is all really dealing with long-term based money, and every retirement portfolio is made up of short-term and long-term funds, and we're here today to kind of talk to you about your long-term funds and how you can leverage those inside a beautiful account like we're going to show you, that really gives you a lot of 21st century advantages for that. CDs and savings, and again, over and above on CDs and savings, over and above your emergency account, over and above your peace of mind. It depends on, everybody's a little bit different. What do you need in your checking account to feel safe? Do you try to keep a 5,000 balance, a 10,000 balance, a 20,000, and everybody's a little bit different on what needs a peace of mind. So that is not what we're referring to this morning as possible funding sources. As I joke with my clients around the nation, and as our team connects, around the nation for these sorts of programs, I always joke a little bit here. We're trying to isolate that emergency to the emergencies fund at the bank, that longest term money, that money probably isn't doing the best at the bank that it could, but you really don't know anything else out there to do with it, and you don't want to put it at risk. So another kind of mindset there. And inheritance, again, that's going to be excess probably to your specific nest egg out there in regards to where you fall. So all kind of possible funding sources, and I'll get into that a little bit more. But if I can, before I move off this slide, please try to remember the short term versus long term, and that no is really short term, if you will, and yes is very long term. So let's talk about for the next few minutes kind of the top 5 threats to your retirement and what that looks like for you and in a very bullet point based sense. And really the number one fear, as you can see there, is running out of money. The number two fear is death of a spouse and what impact that would make, not only emotionally, of course, but also, financially, fiscally, and what that looks like for you. The rising and epic cost of healthcare costs as they continue to rise and where that falls. And number four, inflation. I'll be the first one to tell you, how much, how much more expensive things are. My wife is a adjunct professor at a local college, and then my kids. I've got a 12-year-old son turning 13 tomorrow, and then a 9-year-old little girl, and things are extremely expensive. What we've seen over the last 4 or 5 years, really has taken our nation about 15, 20 years and kind of past, inflationary modes, if you will, to get where it's gotten over the last 4 or 5 years. So very important to understand. And then number five, market volatility. And I kind of slowed down there and really emphasized that. How much of your nest egg, how much of your investments are subject to market loss? And diversified, folks, really isn't good enough anymore with programs like this out here. What do I mean by that? If you are actively managed, if you do have a directly invested portfolio, to be diversified in that portfolio simply means that you will go down less than the overall market. It means you're losing. It means you're falling, which we'll talk to a little bit more in a second. But to reduce market volatility as you age is a very important factor. We have an election coming up. I don't know if anybody kind of knows that out there. And election years are very volatile years in the market. And what makes it a little bit worse this year is we're coming into an overall 12 to 14 year record run on the market. Our last major market correction was in 2008, and this is a very tumultuous year possibly coming. So number one, kind of wrapping back in, is running out of money. One of the most important things to take care of and shore up in your retirement, life, if you will, is the unexpected need for nursing, home care, or assisted living. This is one of the biggest unintended, unexpected costs you will ever have in your entire life. If you can see there, the in-home care average, if you will, is about $6,000 a month. Community and assisted living is roughly about $5,000 a month. And nursing care, depending on, exclusivity or where that falls there and your level of care that you need or require, roughly $8,000 a month. So running out of money is a very big threat when you add in the factor, so to speak, of long-term care and what that unexpected need would do. So this is just great facts for you, great kind of an understanding of where that falls. Losing a spouse or loved one, There's lots of things that go into that. When your spouse, God forbid, or if your spouse has, or when your spouse passes, your tax bracket also changes. Your earning limits also change in regards to what you're charged for Medicare Part B, what your federal income tax rate is. And that is a very important thing to understand and where that falls. And nearly 4 in 10 families would feel the financial pinch within 6 months, of that Social Security, going away, of that. And in our states that don't have Social Security out there, it's very important to know that you don't really get surviving spouse benefits more often than not, or you get a fraction of what you should. Life insurance can certainly help that with a spouse, but also having a proper 1, 2, 3 nest egg kind of retirement income-based pension plan is a very important aspect as well. Healthcare costs. Healthcare costs are, the one of the number one topics that you will hear just in general in your everyday life. Doctors are very hard hit right now, and hospitals are very hard hit, and the insurance market is very hard hit. Costs are soaring, and nobody wants to cover the bill. So that generally means that it's falling on clients, it's falling on retirees, it's falling on you more and more. Medical debt is the leading cause of bankruptcies in the U.S. today. Very much cancer-related care may not be covered by medical or insurance. Really, a lot of the out-of-pocket non-medical expenses associated with cancer. For goodness sakes, you'll get help at the hospital, and those sorts of things with a lot of things. But about 60% of the cost associated with cancer care are out of pocket or non-medical based expenses. So that is on you. That is on that. Larger deductibles and balanced billing can very much cause surprises out there. Heart disease, heart attacks, heart strokes, and chronic conditions, as well as just the overall healthcare kind of lack of coverage or overall diminishing coverage. Think back, everyone. I've done this since 2008, and the health care that the retirees down in Texas received back in 2008 is a fraction of what the health care the retirees receive in 2024. The plans are more expensive, cover less, higher deductibles, and that is a trend that is going to continue as time goes on. So very much a threat to things, and inflation. So the impact of inflation is one of the biggest kind of slow deaths, if you will, to your retirement nest egg, to your overall spending power of your money. And inflation is one of the biggest threats to your money at the bank. So if you have too much funds at the bank, too many funds at the bank, inflation is slowly clawing away at those. So banks will never keep up with inflation. Bank rates are decently high right now because inflation is high. They're cyclical. They move together. The higher inflation is, generally, the higher your earnings you're going to get at the bank. I always talk about my grandfather. He passed away at 92 about 3 years ago. He was a World War II veteran and one of my best friends out there in this world. And I thank God every day that my kids got to know their great grandfather, very similar to how I got to grow up with my grandfather, with him living as long as he did. And Pop still chased those 15-16% CDs to his ultimate calling up above a few years ago, even when rates were 1 or 2%. And when the CDs were paying, 10-15%, you better believe inflation was right alongside there. And very case in point, if you look at what these average inflation rates are, depends on kind of what news network you look at based on kind of what inflation rates are, if you will. I personally believe in my exact situation, I believe inflation rates are roughly between 6 to 8%. And I think this is a very, very, very conservative, and I don't think it really takes into account, in all due respect, I don't think it really takes into account the gallon of milk, the meat at the store, the eggs, and all those things we deal with on a very everyday basis. But that being said, looking at roughly 3.5% here, what are rates at the bank? Rates at the bank are roughly 4.5%. And, if we use these numbers, which again, I don't think are truly right on with our everyday life-based stuff, that's right in line there. So inflation is an absolute killer to retirement savings and retirement income. So again, kind of what that second bullet and last bullet said there, many retirees see their purchasing power erode because their savings and interest rates do not keep up with the cost of goods in the area. And so it's really, really important to understand, where that falls and what you can do about it. It's knowledge is great, but what can you do about it? What can you do about it? And we're here to give you a few options. And market volatility is exactly what we're going to be visiting about, and what that means for your options in retirement, your options in a safe investment program as we have, and really what that means for you. So market volatility, that big old orange arrow on there, that was our last major market correction. That was 2008. My father had to go back to work for 18 months. My dad retired 3 months before that happened. My dad retired right as this was going down. And you know what his investment person told him? Don't worry, you're diversified. And my dad had to go back to work for 18 months. So market volatility is one of the biggest threats. How long do you have to let your direct broker, or what that looks like if you're brokered, how long do you have to let them get it back? The average market recovery is about 8 to 10 years. If 2008 repeats itself this year, post-election, pre-election, the first year, whatever the case may be, 8 to 10 years on average is what it takes to get back to where it was. And that's being quote unquote diversified there. If we can show you a way to not have to worry about market risk, to be able to take care of every tax advantage out there, to be able to mitigate your loss, mitigate your risk, and mitigate your fees, to be able to do these things for your overall benefit and your heirs and your beneficiaries' overall benefit. That's our goal today. So taking a hit to your retirement savings when you can't afford it or have time to make up can absolutely crush you. Can you afford, to take a 48% drop, to take a 32% drop, to take a 12% drop? And do you want to go through that again? History is doomed to repeat itself if we forget it, right? If we forget it. And 2008 was a absolutely, repeatable event that we are very, very much poised to, and coming up. So market volatility is one of the biggest things that we can take from there. So between February 12th and March 23rd, the Dow lost 37% of its value. By the middle of March, panic was rising and the US went into lockdown mode. Over 20 million jobs were lost. Investors watched as their retirement savings lost 30% of value in 2 weeks. So the red is what we're trying to prevent for you all. So and keep a little bit of your assets risky. Keep a little bit of your assets, quote unquote, diversified in the market, if you will. But jot something down if you're taking notes or if you haven't, and Google it. That's I used to say research, right? Research things, and 9 times out of 10, that research means we're Googling, if you will. So Google what is called the rule of 100. The rule of 100. It is a sound financial principle that is very, very conservative and very, very apt for you all in this group and for you all across the nation that we do this for. The rule of 100 states, whatever your age, if you're 70 years young out there, that is the percentage of your assets that need to be free from market loss ability. The other 30% of your assets, let them ride, let them be diversified, let them be on the roller coaster if that's what you get. Let them go after as high of growth as possible out there and let them be subject to loss. But if the market and the overall, financial market drops by 20%, 30%, it is a portion of your assets doing that and not the whole thing. So very, 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 very important rule. And what we really try to recommend and get our retirees around the nation to really at least research and understand is that rule of 100. So how are your savings rates these days? So again, this goes back into what I was saying a little bit. So the banks are, are decent. Again, inflation's decent. Banks are decent. I remember, 2-3 years ago, back in 2021, we'd call each other about a 1.5% CD at the bank, and a 1%, mortgage rates, for goodness sakes, a 30-year mortgage rate was 1.5%, 0% car loans were everywhere, and inflation was 1 to 2%. Inflation was very, very low, very, very normal. So the bank is a good thing to a point. And we're here today to give you another option outside of the bank. So, diversify yourself across investment opportunities across your portfolio. When I kind of talk about diversity negatively, it's in that directly invested portfolio, that 30% of your assets if you're age 70. But when I talk about kind of overall portfolio diversification, it means having money in the bank. It means having money under the mattress, jokingly, if you will. It means having money in a loss-free account. It means having money in a loss-based account, but in the correct proportions, out there. So again, number 5, market volatility. And you all, thank you for staying with me up to this point. These next few slides are really where I get an opportunity to transition into our program and into the what and the how. So up to this point, hopefully it's been some good knowledge, some good nuggets, some good kind of rules of 100, and good insight into overall things. But this next portion of our presentation of the webinar this morning is really going to be geared into what can you do about it and how can AMBA help you do that. I will refer back to the QR code that Chris visited about in the very beginning. That QR code is your opportunity to snap that, to raise your hand, get more information. That goes directly to Kristen, and she handles that through her advisors, and that is it. It is an in-house thing. It doesn't go anywhere other than that. And so very, very important. So market volatility, and how is that a possible solution? Well, market volatility is the threat. We have a solution to counteract the old way of volatility. So 63% of Americans are more worried about running out of money in retirement than death. So nearly 2 in 3 Americans worry more about running out of money than death. So our opportunity, our tax deferred asset protection program, everyone, it provides a lifetime of income and safety. It allows access to competitive returns. And this third bullet is one of the most important things. It is upside potential in the market with absolutely no downside risk. And it protects your assets 100% from market risk. Now, I will say, and I will always refer to that short-term versus long-term. This program that we'll transition into now, our tax deferred asset protection program, is not meant for your short-term money. It is meant for your long-term retirement savings, inheritance-based funds, funds that you need access to, don't get me wrong, but you can afford to kind of set them aside a little bit. So tax deferred asset protection program can provide, it has absolutely no underwriting. You have the opportunity to participate in market gains with no downside risk. It accepts both qualified and non-qualified funds. So referred to those terms a little bit earlier in the IRA 403, 401, 457 space, if you will. That is what's going to be called qualified funds. The way to best think about that, those funds are qualified for required minimum distributions. Those funds are qualified for Uncle Sam to start making you take out of those every year after the age of 73 in the new laws, if you will. Old way was 70 and a half. New way is 73, if you will. So multiple investment strategies inside our tax deferred asset protection program. And it has one of the highest liquidity and one of the best access of this program in the market space, and possible long-term care benefits wrapped into here and tied with it. So here it is, and I'm going to spend quite a bit of time on this slide right here. So Ameritas, everyone, is our provider of our fixed indexed annuity, Ameritas is an A+ rated carrier. They have been around since 1887. So they opened their doors a few years after, just really the major emerging of our financial markets. And so they, of course, saw the Great Depression and quite a bit before it, and absolutely everything after it. Ameritas has one of the highest ratings out there at A+ with Standard & Poor's and A rated by AM Best. Ameritas is one of the most solvent, strong companies out there in this space offering a fixed indexed annuity. You might recognize Ameritas from our dental and some little bit of our vision offerings around the United States. And very, very important to kind of have that brand recognition. And Ameritas is one of the top companies out there. This particular program and a fixed indexed annuity is a perfect fit for our member demographic. And why is that? That is because it has enhanced liquidity or enhanced access to your money if nursing care is needed, if home health care is needed, or if terminal illness, comes in, God forbid. An annuity is a contract, everyone. An annuity is an investment with a company and with an insurance company such as Ameritas. And in turn with that, the type of annuity this is, again, is a fixed indexed annuity. There is absolutely no downside loss with that word fixed being in the title of this program. There are two basic annuity types. There are variable annuities and there are fixed-based annuities. And this program through Ameritas is on the fixed spectrum of annuities. This program through Ameritas gives you a guaranteed growth opportunity on a portion of your assets through what we call the fixed account. And with another portion of your assets, you get the opportunity to go after much better than fixed rates can offer through 4 different safe index growth options. One of the best and things we utilize most often inside the fixed indexed annuity is the S&P 500. So a very, very neat, very simplistic way to see this is if the S&P 500 grows, you get credited that growth up to a limit. So there is what's called a cap or a limit on what the S&P can credit in your account that given year. And here's why that is. Because if the S&P loses value, you have absolutely no downside loss with the S&P 500. If the S&P is growing, you're getting interest credited. If the S&P is falling or losing, that money that was looking at it stays the same. So you're either climbing or staying the same with the portion of your money looking at the S&P 500. So very, very, very important to understand that, and very, very important to understand how. How is that possible? With a fixed annuity and a fixed indexed annuity, the carrier, Ameritas, is taking 100% of the downside loss if the S&P loses value, or if if you look down there at the bottom, we have 4 different safe index growth options inside of here. Depending on market forces, we might use a combination of them for the given year or just one of them. And right now the S&P 500 has done very, very well. So we are utilizing the S&P 500 inside of here more often than not on the portion that is safely going after much better returns than just a fixed account could ever get, with putting 0 of your money at any sort of risk. So very important to understand that. So with this account, there is no underwriting. You're participating in market gains with no downside risk. Again, accepts qualified and non-qualified funds and adjustable internal options. So I've kind of hopefully led you down to that bottom bullet there. So inside of the fixed indexed annuity, it is the absolutely beautiful alternative to the bank. It is also a beautiful alternative to a directly invested portfolio where you're paying fees, where you're subject to market loss. Because inside of a fixed indexed annuity, there are diverse interest crediting strategies, none of which put you at market loss, none of which subject you to any sort of loss at whatsoever. You get the opportunity to simply grow with the market, never fall off, never lose value, and never go down. So this is an account that is always climbing. We have a guaranteed fixed account rate, and a way to kind of think about it is, again, a portion of your investment would be tied to a guaranteed rate initially, and another portion of your investment would be going after better returns than a fixed account could pay. And the fixed account is roughly about 4% right now inside of the program. And there's another power of this program that I'm going to refer to in a minute that's called tax deferral. But kind of expounding what I went over just a little bit on the 4 different safe growth index options. You know, how is this possible? Hopefully, a lot of you are kind of asking yourself, how is this so? This sounds too good to be true. And it's not. It goes back to the exhaustive nature that I've went into up to this point on isolating the correct money type for investment in this program. This is not meant for short-term money. This is meant for long-term money. Why is that? What is the trade-off in coming to an account like this? It is a little bit of loss of liquidity, So you are giving up a little bit of access to the funds that you bring over here. And many of you might have heard this, know this, have this, understand this with an annuity. How does Ameritas make money? They limit your access to a little bit of your funds to be able to make money on their end, for you to be protected from all market loss, for you to be able to take advantage of market-based gains, while at the same time having the different diverse growth options that a bank could never dream of giving you, or your stock portfolio has to put you at risk to be able to take advantage of better than bank rates. So very, very, very hybrid 21st century program here. Everybody, there has been over 240 billion with a B invested in in fixed indexed annuities across the United States in 2024 alone. It is the new way to be safe, but to not park all your money at the bank and take a very, very low non-tax deferred fixed rate. Growth that is experienced inside a fixed indexed annuity is tax deferred growth. Taxes are not due. It is not earned income like it is on a CD, or like it is if you withdraw, so to speak, out of your brokered account. It is not earned income unless you withdraw. So not tax-free gains, unfortunately, but that doesn't exist, but tax deferred gains. So the power of tax deferral. So when I said the fixed account rate is roughly a 4%, you might say, well, I can get 4.5%, I can get 5% at the bank. But at the end of that year, you're getting a 1099 from the bank, and you are paying earned income on that interest, whether you wanted to utilize it or not. Your money sitting safe inside a fixed indexed annuity is tax deferred growth. So again, coming back and really, if we can, please try to look at that box down here, that multiple ways to access your funds. One of the main reasons we chose Ameritas for their fixed indexed annuity. Ameritas doesn't have the only fixed indexed annuity out there. We just feel theirs is the best for our retirement, our retirees around the nation, for our demographic, if you will. That's the fancy word I was looking for. So that being said, again, what do you give up by coming to a fixed indexed annuity? A little bit of liquidity. By no means are you cut off from your money. By no means do you not have the ability to withdraw. And by no means do you not have the ability to get every cent of it if a major health ailment comes up. And this transitions into the long-term care side of it a little bit as well. So money that comes over here is money that will never go down again, only up, only climbing, only growing. In this multiple access to your funds here, everybody, this is one of the main reasons we chose Ameritas. Each and every year after the first year, you have a 10% annual withdrawal that you can take from your account. So again, it is just that first 365 days that you do not have what is called a penalty-free access to your account. It's your money, for goodness sakes. You can always get to it. But if we dip into it the first 365 days, unless it is your required minimum distribution that Uncle Sam is forcing you to take out, if you will, unless it's your required minimum distribution, it will take a little ding, a little penalty. Your normal access begins at the first day of the second year, day 366. You can pull 10% of your value out. Of course, that can be split over monthly payments. That can be split over quarterly. You can get, as little or as much out of it as you need. One of the very unique things that Ameritas offers is an extra 10% one time in a given year throughout your contract. So what does that mean? And that is, again, after the first year as well. So that means if you're getting your normal 10%, just for whatever reason you need, and you have an emergency arise, it is a bullet point list that Ameritas sets forth that triggers the emergency access. You are able to get up to 20% of your account out in a given year along your contract period. So very neat there. And then really what takes the cake, if you can see down there, the second sentence from the bottom on that multiple ways to access your funds box is the word waiver. The word waiver. So if there is a nursing confinement, if you see there, and surrender charge waivers for confinement in nursing care, that is a nursing home confinement, a home health care need, or a terminal illness that is diagnosed, it is your fees, your surrender charges. I'm sorry, this account doesn't have to, but your surrender charges, your penalties are 100% waived, and you have access to 100% of your money if one of those health ailments arise, which makes it so unique on this program. There's not a lot of other carriers, and to our knowledge, there are no other carriers out there that offer a long-term care, nursing care, home health care waiver that gives you the peace of mind that if I do put my long-term money in, I've kind of in the back of my head said, if I need nursing care, if I need home care, if I need these sorts of things, this is the money I'll use for that. Well, that money can park over here as well. That money can grow better than where it was, almost assuredly. It can be safer than where it was, almost assuredly, and it will be 100% available if that need arises for me. Let's look at this account. So I kind of mentioned earlier, the S&P gets to grow to a cap, grow to a point. And that is where Ameritas kind of comes in and where they get an opportunity to make a little bit of money on your money while at the same time protecting you from 100% from any and all market loss. And so there's two lines here, everybody. There's a green line and there is a blue line. And the green line here is what a fixed indexed annuity, how market or S&P 500, Russell 2000, or other indices we might utilize. This is what your account looking at the market would look like inside a fixed indexed annuity. So this is a sample $600,000 investment here and letting it ride. So the green line is a fixed indexed annuity. The blue line is the traditional roller coaster. The blue line is where your broker wants you. The blue line is where your advisor wants you, because there's fees on that line. You know, whether that's a loss of 23%, you know, if you look down there kind of in the beginning, or an epic rise of 16%, if you see there over the side. Your broker and your advisor's getting fees no matter what's happening to that account. And you are getting a whole lot of emotional woes throughout that process as well, all to ultimately end up at the same place. So if you look at the green line, when it is flat, when you see a 0%, that is when you see the S&P itself falling. So if the S&P falls, you just don't get interest credited that year. There is absolutely no loss in this account whatsoever. Again, a fixed indexed annuity, never a variable annuity. When the S&P climbs, you get to grow up to your cap. And I don't know a retiree or a client one, myself included, that wouldn't be happy with an 8% return when the year before, when all of their friends lost 18%, they stayed the same. And so it's a very neat thing to understand. So if you look there and you really see that, you know, the blue line is the old way and the green line is really the new way. Again, if we're isolating the correct money type, if you will. So this is a fixed indexed annuity, folks, at its finest. And recall, kind of coming back here just a little bit, and if you look back down at that very bottom bullet point, if you see that adjustable internal options, you have a guaranteed fixed account rate and 4 different safe index growth options. And again, we normally tie to both. We'll put a portion of your assets to the guaranteed fixed account rate that is going to grow regardless of what the market side of your account did. And then that bottom bullet, we have 4 different indices to choose from. You just saw an example of the S&P 500 with an 8% cap there. And then that gets an opportunity to simply grow, never lose. You're either climbing or staying the same, which is really, if you ask yourself, what most clients really are after and really are looking forward to. This is a great little graphic here, a fun little chart. I won't spend too much time on it, but it really is something that gives you an idea of the tumultuousness, the variability of a directly invested portfolio like the blue line on the last screen. It really depends on kind of market timing. You know, when did the market go down? How much time have you had to recover, and what that means for your overall average rate of return And are you tired of this? Is this something that you've gotten to this point and you're tired of it? And so really this is a sound kind of life principle that I learned years ago, and I've had many retirees help me through my career, understand things as I kind of gush about my son, gush about my daughter, my wife, those sorts of things when I'm meeting with clients, age is wisdom. Age is wisdom and age is experience. But it's a very neat thing. But the investment vehicle or the mindset that got you to where you are today is not necessarily the exact same thing that needs to get you to the pearly gates, to get your account to your kiddos. So just because an account has done good up to this point does not mean that that same account will continue to do good amidst a 25% market decline. And a fixed indexed annuity is a different way, a transition, a break point in your retirement that gives you an opportunity to transition a portion of your assets over here to be able to grow safer, 100% safe, grow better than the bank, not lose the excitingness that you get from the market. I mean, goodness sakes, depending on what the indices do, there is very good growth potential. And to not put your returns, to not put your retirement on the chopping block, if you will. So prepare for many more years of living. Clients and retirees are living much longer today than ever before. Will your retirement, will your nest egg, hold up? If you are of age 70 and a half or older on the old rules, if you will, or 73 or above, if you are taking your required minimum distribution. So what I'm about to say here, everyone's a little technical, but I want to kind of display this. If you are taking your required minimum distributions and you have your account at market risk, Uncle Sam does not count market loss for a distribution that year. Uncle Sam is going to want his required minimum distribution out of your variable account, regardless of market loss. And if you are living longer and longer and your account, you might live off that required minimum distribution. You might base it off of that. If that account is subject to market risk and you're being forced to withdraw out of it, this life expectancy side of things is very important. All big kind of high up topics, if you will, that a fixed indexed annuity can solve. A fixed indexed annuity is an absolutely phenomenal option for a portion of your retirement that absolutely is something different than you have. And then everybody, what's your take? How will a scrambled nest egg affect your retirement years? And here is this QR code again. If I've brought up anything with you today that struck a chord that you'd like to learn more about your specific situation, please, scan this QR code, connect with one of our local advisors, and let us help. Don't be one of the ones that heard about a fixed indexed annuity and didn't take advantage, or at least didn't find out about it before the market dropped 20-30%. So what do they say in Vegas? You go to bed when the chips are high. Everybody, the chips are still high. So in the market. So go to bed. So thank you all for your time. Thank you all for allowing me to come on here this morning. And I hope this was informational. Thank you, Chris. You there?
Absolutely. Thanks so much, Dallas. We appreciate it. And you could leave that slide up for a minute. When you do click on the QR code, you will let's see what comes up over to the right there, where it says learn more about benefits available through your association. And so all those different benefits will come up, and those are available to you to ask questions about. So whether you have a specific question, for Kristen and her team, about the FIA that we just talked about, or anything else that's listed on there, please feel free to click on any one of those products and it'll go directly over to Kristen, and then she can follow back up with you. We do appreciate all of your time today. I do want to ask Kristen to go off mute for a second and to just verbally give your phone number probably twice, just in case anybody wants to reach out to you directly rather than filling out the form. So I'll turn it over to you.
Absolutely. So you can reach me at 678-510-0949. 9155. And again, that's 678-510-9155. Thank you.
Perfect. And in case you didn't get her phone number, in case the QR code isn't working, in case, if all else fails and you say, hey, you know what? I thought about this for a few days and I really want to get a hold of Chris, Dallas, or Kristen, just give your association office a call and they have all of our phone numbers, emails, etc. They'll be able to direct you to us immediately. Thank you. I want to thank you again, Kristen, Dallas, for your time today and everybody else that joined us. We really appreciated having you on the webinar, and that'll conclude the webinar for today. So everybody have an amazing day, and thanks again.
Thank you.